This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're very fortunate to be joined by none other than Tom Lambeth from VP Capital, who's been one of our regular contributors to Talk Your Book. Tom, thanks very much for coming back on the show.
Pleased to be here, Chris.
Now, what stock did you want to talk about today?
Liontown Resources, please.
Now, if I look through the price action from the Market Tech graph over the last 12 months, looks like they had some good drilling success at Bildania in March that led to a bit of a re-rate, and the binding off-take agreement with Tesla in June was something that the market liked soon after. It probably hasn't had the same explosive growth as some of the big lithium cash producers like a PLS or maybe some of the explorers as well. Do you attribute that to them just being in a different phase of their journey than those other two types of lithium players?
I think that's right. You know, I think we always think developers should trade on a discount naturally to producers, and I think the market's probably given the producers a bit of a halo effect because, you know, spodumene prices right now are so high, and so they were high throughout the whole year of 2022. And I think equally on the exploration side, you've probably got a little more sort of speculation, whereas a developer, we know it's probably going to happen. You know, maybe the market's a bit more sort of tempered and rational about things.
Now we'll dig into LTR and their Kathleen Valley project in a minute, but maybe let's start with the lithium market overall broadly. How are you viewing that market from a top-down perspective? Yeah,
so I think, you could accuse me of sort of being foolhardy here, of coming onto your show and picking a lithium stock, because the market, has been explosive. Certainly in the last couple of years, where we've just gone through one of the biggest bull markets that I've seen, in the commodity space. And but I think there's valid reasons that warrant a look here. And on the supply side, I think there's like 100 new battery factories that need to be built from now until 2030 to basically keep up with the forecast demand, which is projected to grow at between sort of 10 to 15% per annum. Now that's 3 to 4 times GDP. I think it's still forecast to be very explosive. China and the US and Europe are leading the way, but in particular China. And our intelligence there is, EVs are flying out the door, even now. And even, Albemarle forecast EV growth to be about 40% in 2023 on 2022. So from already a high number, yeah. So I think there are demand side factors here that really support maybe a longer bull market than everyone's thinking. Equally, it takes a long time to build a lithium mine, to then sell it downstream to a battery manufacturer, yet alone build a battery sort of factory, a plant, and then to eventually sell it to to an OEM like Tesla or Ford. So there's a whole supply chain here which needs to catch up. I think one interesting comparison, which a lot of smart people draw their attention to, is the iron ore boom in the early 2000s. Is there a parallel there? And maybe. Iron ore, as you recall, was $20-30 a tonne at the start of the 2000s, and when Andrew Farrell's through sort of raising capital and building Fortescue, it then kind of re-rated structurally to $100 a tonne and kind of stayed there. And we've had cycles, since that, but it sort of seems to have stayed at $100 a tonne.
That was my biggest takeaway from Diggers and Dealers, was that the people that were from West, I think a lot of maybe Melbourne-based investors and Sydney-based investors, particularly if they're not that exposed to resources, see what's happened to lithium prices and just dismiss it as just a bubble that's going to mean revert and come crashing down. But the people in Western Australia, well, there's not just one person, but broadly speaking, the mood out of diggers that had seen that iron ore boom was that they felt this was iron ore 2.0, and some of the players, Min Resources and the like, are sort of acting on that belief and have done well so far. So maybe just psychologically, how are you handling that fact that it has been such an astronomical price rise already? Are you just simply looking back at the numbers and being data focused and trying to not let your emotions rule you one way or the other?
It's really difficult, and you know, psychologically, but also a lot of people have made a lot of money, and so naturally the tendency is to realise that profit, and sometimes that can have a downward movement on share prices in the short term, which doesn't help the psychology either. So, you know, I think it's just something you have to manage and try and look through. And maybe if you want to buy a stake in a company like LTR, to try and, you know, average in over time, you know, don't buy it all at once. That's what we try and do. Obviously, it's easier said than done. You know, on the psychology front, it's just something we need to deal with, I think, collectively.
And so let's dig into the Kathleen Valley project. How big is it? What's the grade? And where do you think it'll sit in the cost curve when it's ramped up to full production?
Yeah, so Kathleen Valley is one of the largest you know, hard rock mines in the world. Greenbushes is actually the largest mine, which is owned by IGO and Tianqi Lithium and Albemarle, and that's you know, that's sort of 2 million tonnes a year roughly of spodumene. Kathleen Valley is forecast to be around 700, so call it a third of the size. So it's up there. The grade is very high, so it's higher grade, long mine life, and a large asset, 30-year mine life, grade of 1.4%, which puts it ahead of you know, Galaxy's Mount Cattlin, or should I say Alchem's Mount Cattlin these days. And so it's right up there, and it's interesting because LTR owns 100% of this asset, which is an unusual situation. You know, it probably puts it maybe in the range of being acquired at some point. But certainly high quality asset, which is one of the reasons why we like it. The other reason why we like it because it's cheap as well.
And started digging up some ore by the open pit yet to actually produce a finished product. When do you actually think they'll go into production?
So 2024 is the forecast. So they had an FID, a DFS finish last year, FID, you know, capital raised, and we're expecting maybe DSO in sort of early 2024, maybe a bit earlier, but then, you know, full sort of spodumene output by mid 2024. These things are typically, you know, subject to delay, of course. So, you know, give or take, we think.
And they've got upstream operations coming on, but also down the track around 2030, they're potentially planning for some downstream operations. Maybe articulate the difference between those two and whether or not you really even want those downstream operations to come on board, or if you'd prefer them to save the capex and leave it for someone else. Yeah,
I think it's interesting because it's really you know, a different part of the value chain altogether, and requires you know, sort of specialist you know, chemical engineering skills. To really operate and sort of take the spodumene and process it into something which is, you know, more of an input to the battery supply chain. And so these plants can often cost, you know, billions of dollars and take, you know, many years to really perfect the right sort of output.
And it's a different skill, isn't it, from being mining to being a specialty chemicals producer? Is that sort of fair?
I think it's a completely different skill, yeah. So I would personally prefer, as an investor in Liontown, you know, for Liontown just to stick to their knitting and stick to sort of upstream.
There's no requirement from the government to actually commit to the downstream processing?
I mean, not that I'm sure the government's supportive, but I'd be shocked if there was a requirement. That would sort of seem a little bit onerous to me. Yeah.
And talk to me about the offtake agreements, signed offtake agreements with Tesla, Ford and LG, and the debt deal as part of that Ford offtake agreement. Walk us through what those mean and how much percentage of their offtakes now spoken for.
Yeah, so just a little under 2/3 of their production is spoken for, and I think it's fantastic to have, you know, 3 of, you know, the biggest OEMs really in the world backing you. So it's interesting the path they've chosen here, and you know, obviously being in a tier 1 jurisdiction in Australia, being able to have offtake with global brand names, and then use those offtakes to also, as part of the deal, to be able to raise some debt and help fund the project. So as a result, Chris, we understand the project is now fully funded to first production as a result of those debt deals, and then the cash they have on their balance sheet. Probably worth noting that I'll just temper that a little bit, because with single asset companies, you can always have, you know, a working capital problem at some point, and you know, with the timing of things, and you may need to do a small raise to kind of bridge. but we don't, anticipate that to happen here, but it's possible.
And talk to me about just the broad brushstroke numbers, what the market cap is, and maybe once ramp-ups occurred, assuming lithium prices stay where they are, what sort of cash can a project like this spit out?
I think this is one of the reasons why we're really attracted to the company. I mean, I'll give you first of all a bit of a ridiculous spot scenario, which is you call it spodumene prices of $6,000 a tonne US. Let's call it 8,000 to 9,000 Aussie, and their all-in costs, they're saying is let's say it's sub 500 US. I mean, I don't believe that. I don't believe that. I think it's going to blow out. I think the likelihood by the time they produce it, let's call it Aussie 1,000 to be conservative.
Okay.
So a spot case, and they're pumping out 700,000, tonnes a year. So you can pretty easily get to a number over $5 billion of EBITDA. And if you look at the total cap structure, market cap, net cash, and then if you add on the fully funded sort of debt that you need to get a pro forma 2024 cap structure, let's call it $3.5 billion is kind of a nice round number. So spot scenario, you've got five and a bit of EBITDA versus, a cap structure of 3.5, sounding pretty cheap, but less than 1 times.
As the meme of that soccer coach is saying.
Yeah.
Apologies to podcast listeners that won't see that, but it's juicy, isn't it?
It's very juicy, and there's the old adage of never buy a commodities company on the basis of a high commodities price, and so because you'll probably lose money. I think the way we looked at this is not just to rush in and look at the spot scenario, but if you temper it a little bit, and brokers, Goldman's, basically a UBS, Macquarie, they've all got long-term targets of around low 1,000s in real terms. So that's, call it 5, 6, 7 years away. That's probably your worst case scenario. In the interim, by the way, I think that's too bearish. So the interim, you could probably use, between 2 and 3 and still get a number which is around, 1.5 to 2 times EBITDA, which we think is too cheap.
And does that all in sustaining costs? Where does that put them on the cost curve? Is that bottom quartile?
Yeah, I think, look, they'll be bottom quartile, but I'm not convinced that those costs won't blow out. So if you look at what's happening in Western Australia at the moment, you've got very high labour costs. PLS, I think, is producing it all in for more than $1,000 a tonne. I wouldn't be surprised if Kathleen Valley ends up to be in the same sort of ballpark, which would still allow them a profitable operation, no question, at these prices. So it's a punt on the lithium market, absolutely.
And what are the next potential milestones that could lead to a re-rate in the next, call it 3 to 6 months? What things are you looking out for?
Look, I think the upside risks are just the realisation by the market that this project will happen. And as we get closer to that, typically you see a slow re-rate in the price from developer to producer. That's the obvious one. I think the second one that's overlooked is maybe the strength of the demand in China. And let's have a look at the BYD numbers that come out in the next quarter and then the quarter after that, and hopefully we sort of see how good they are. We think in China owning an EV sort of become almost a status symbol, and so we think it's likely to be stickier for longer, and they're only kind of low double-digit penetrated as well. So
your probably social credit score gets whacked if you don't have an EV in China, wouldn't you?
Yeah, possibly right. But there's lots of incentives too as well, and subsidies, and so that's probably the near-term catalyst, as well as just maybe some re-rate, natural re-rate.
And a few people criticise resource companies when they do just have a single asset, that it's high risk, but it also makes for a much cleaner bite-size acquisition should there be a fellow mining company that doesn't have exposure to lithium. Could you see a world where this becomes an attractive asset for someone bigger to come and mop up?
Absolutely, it is no question like higher risk, and you can have all sorts of issues around working capital management, and that can really impact the share price as well. I think it makes sense as an acquisition, and I think anyone that's not in lithium that wants to get in, BHP Rio makes sense. Yeah, I think I'd be guessing I think it's a natural fit for another lithium company as well, given the jurisdiction, and if maybe someone who's already got downstream facilities built. But it makes sense, you know, it's so strategic, you know. As I said, it's rare to see this where you've got a world-class asset of this scale and one company owns 100% of it.
Well, thank you for coming on. I had friends who were in the reject shop when you came on to talk your book and single-handedly dragged it up the boards 6x or whatever you did. So hopefully it's a similar response for this. That's not spruiking. Do your own research as always. But thanks so much for coming back on the show.
Thanks, Chris.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.